Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined the show for the very first time, a huge welcome. We have an epic series coming up for you over the summer break. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm good, Bryce. Very excited for this episode. Very excited for this series. Over the next 12 episodes, we're going to be speaking to some of the best investing minds in Australia. We're going to be unpacking lessons from their lifetime of investing. But most importantly for you and I, we're going to understand how these great investors would start today.
Yes.
We're going to be unpacking lessons that we can all take and apply to our own investing journeys.
That's it. So some of the guests coming up, we are kicking off today with Nick Griffin. We've got Ben Griffiths, Ricky Bannon, Jeff Wilson, Elise Kennedy, Scott Phillips, you name it. There are a raft of them coming in, and we are super excited for this series. As I said, though, today, Ren, Nick Griffin kicking it off.
Yes. So Nick Griffin is the founding partner and chief investment officer at Munro Partners. They are a global growth manager. The performance of Munro's funds really speaks for themselves. The Munro Global Growth Fund has returned 40% over the past 12 months and has done 13% a year since its inception in 2016. And probably the belle of the ball at the moment, the Munro Climate Change Leaders Fund did 74% over the past 12 months and has done 16% a year since inception in 2021. So pretty phenomenal performance. Unsurprising, the money has followed the performance.
Yes.
$5 billion under management.
Yes, Nick is incredibly experienced. He's been in markets for over 15 years now. So we are very fortunate to have one of the, highest regarded investors at the moment in Australia joining us in the studio to get his thoughts on what is going on in markets. He has a particular, he spends a lot of time in the chip space, so we're looking forward to that. And to your point earlier, Ren, unpacking his investment philosophy and some of the key lessons he's learnt along the way.
Yeah. Now, speaking of great investors, we want to say a massive thank you to Viola Private Wealth for supporting this summer series and helping us keep all of our content free. Viola Private Wealth manages over $2.5 billion for high net wealth investors with $1 million or more to invest. They help individuals and families navigate wealth management from preserving established portfolios to intergenerational transfers and first-time investments. Their tailored solutions make your financial decisions clear, empowering, and aligned with your goals. And we should just say on a personal note, Charlie Viola, who leads Viola Private Wealth, has been a massive supporter of Equity Mates and has become someone that is quite trusted by us here.
That's it, Ren. Viola Private Wealth help individuals grow and protect their wealth. So to learn more, visit violaprivatewealth.com.au. There'll be a link in the show notes.
All right, well, without further ado, let's get to our conversation with Nick Griffin from Munro Partners.
Well, Nick, welcome to Equity Mates.
Yeah, thanks for having me, guys.
So we want to start with the fact that investing is a lifelong journey, always learning something new. It's a pursuit that I don't think anyone ever masters, despite what some people might think. So what are you working on right now?
Yeah, look, I agree with all of that, and I can assure you I definitely haven't mastered it. I make mistakes all the time. What are we working on right now? We are working on AI, artificial intelligence. So we found over the journey that you'll spend a lot of time getting bombarded with what's happening in the economy, what's happening in the macro, etc., and that's great, but that's noise. The best way to make money is to identify a big structural change and identify the winners. That's what our funds are set up to do. So right now, the big structural change in the world is the emergence of artificial intelligence. It's really exciting. No one really knows what's going to happen, including us, and everyone's investing quite heavily in it. Our job is to identify the big structural change, work out how big it could be, and most importantly, work out the companies that are going to win from it. And that's what we're working on at the moment.
Interesting.
We should shout out that at the start of this year, literally on the 8th of Jan, Kieran Moore came on the show to speak about Nvidia. So we'll include that link in the show notes if people want to hear how he was talking about AI and Nvidia at the start of the year. One thing that we're really fascinated from the outside looking in is how great investors can go from, topic to topic, big theme to big theme, and really, upskill and learn and develop like a certain level of domain expertise in, things that you never would have expected you needed to learn. Like 2 years ago, you probably didn't think you'd be an AI expert, but now you're trying to make investment decisions on the back of it. So what's your process to jump into a topic and really try and go deep and learn? And what are some of the like best resources you find when you're trying to develop that knowledge?
The structural change is reasonably easy to identify because it's all around you, right? So for anyone listening, you just see it around you, quite frankly. Or you hear it in common media, or you hear it from the companies that you get to meet. And obviously, because we have large funds, we have a pool of capital, so we get access that unfortunately regular investors don't get. So we get to meet Nvidia. I met them 6 weeks ago. We get to meet the companies. You get to meet the CEOs. You get to talk to them. So that's very helpful. But obviously, your standard investor doesn't get that. The other thing is to, yes, keep your eyes onto what's going around you. But the one thing that's really changed in the last few years, which I think, wasn't around when I started, was, you can get the transcripts. You can just download the transcripts from a quarterly call. You can watch their investor days in a webcast. You get the information here in Australia just as fast as someone in California is getting it. So the information's out there. You've just got to look. And the real trick is let's go back to what I was saying before. Don't get caught up by noise. Just try and look in the right place, okay? So that'd be the first thing I'd say. Second thing I'd say is a big structural trend. So if we're talking about big structural trends, right, the whole world at best is going to grow at 3 or 4% per annum, right? That's what global GDP is, okay? So that's sort of not really the growth you're looking for, right? So you need to find a structural trend. So it has to take share from something else. So e-commerce took share from regular commerce. Digital advertising took share from regular advertising. Podcasts take share from radio, as we were discussing before. These are big structural trends. So to get growth of more than 4%, find something that takes share from somebody else. AI is going to take share from something. Does that make sense? So that's another way to find a structural trend. Those are how you find the big structural trends, and how you learn about them is, quite frankly, on the internet and with the company's disclosures. But the last bit I'd just say is then when it comes down to picking the actual company that wins from the structural change, what's amazing there is it's always the same things. Okay, so it's the same things the whole way through. We talk about this in our investment process quite a lot. But it's always the same with every company that ends up winning, which is they've positioned themselves to benefit from the structural trend, i.e. they can grow their revenue more than double GDP. They operate with a license that allows them to earn more than their revenue, so their earnings grow faster. They can do it durably over 3 to 5 years, so you're growing double GDP for more than 5 years, so you're doing something quite clever. But the last two are really important. You generally have a controlling shareholder or highly aligned management, like people who got a lot of skin in the game. And you've always, always, always got amazing customer perception. Your customers love you, okay? If you've got those 5 things, you're a great growth company. And so to give you an example, over the years, and I talk about this all the time, Apple had all 5, and BlackBerry didn't. Amazon had all 5 and eBay didn't. Nvidia has all 5. And Intel doesn't. Here in Australia, Macquarie has all 5 and National Australia Bank doesn't. That's why Macquarie just always beats the other banks. And so these things around controlling shareholders, highly aligned management, always focused on your customers, they're always the same across all the industries. And so that's the sort of things that are quite common.
What does highly aligned management mean to you? Like, are there certain metrics or certain percentage ownerships that you're looking for? Or
every business in the world is trying to target an opportunity that I just talked about. And 90% of the ones that get it wrong are normally getting it wrong because of some sort of shareholder dispute. They partnered with someone who had equity, who had a different view as to where they should go. They weren't able to agree at a shareholder level to be able to execute on the opportunity. For those of you who've watched The Social Network, right? It's a good old movie about Facebook. They're all arguing about, we've got to do ads, do ads. And Zuck's like, no, we're doing this.
Yeah.
And he had control, so he could do it, right? So that ability to control the direction in the future, this is something that obviously Elon Musk's done very well over a long period of time now. So it's always a shareholder's dispute that stuffs them up. Somewhere in the world, there's a bunch of people who own shares in Ask Jeeves. They're going, we missed it by that much. And that's basically what happened, right? So control is an ownership structure that allows you to execute and win, and a management team that has the power to do that. And so sometimes that can be a controlling shareholder. Doesn't have to be that. Sometimes it can just be a good board structure and CEO structure with the right incentives to get them to win. But, Charlie Munger says this as well, like, show me the incentive structure, I'll show you the outcome. That's what you're looking for. Because that's what allows the best companies to execute over a long period of time. And remember, there's only a few that are going to win. They're all positioning for the same opportunity. Everyone knew e-commerce was going to be big, but there's only one Amazon, right? And why? Because Jeff drove it maniacally for a long period of time. And so that's what you need to beat your peers.
Yeah. So like with the Macquarie example, there's no controlling shareholder with Macquarie, but like all their employees have like shares and 10 years vesting, so they're thinking long term. Is that kind of what
Pretty
you mean?
much, yeah. The Macquarie example is a great one because, that was started by some visionary people over the years and then passed it down to the next people. And so everyone you speak to at Macquarie speaks the same way. Does that make sense? And it's been like that for decades. And yes, they pay their staff well. But even when you go into the medium management or the people, that you and I get to meet about, they all speak about the company the same way. And so that is in this wonderful thing we call culture. And they have the right culture that's been built up from a long time, but which comes from their startup. The beauty of Macquarie is the way it started up is still how it's run today. And that's a very clever thing that they've done. And yeah, they pay their staff well, and that's good. And so the incentive structure's there as well. And so that's why they beat NAB.
Yeah.
Whereas NAB, I'm not saying nasty things about NAB. But they, the CEO changes quite regularly, and the staff turnover quite regularly, and potentially not as incentivizing as well. And so the culture is probably not as strong, and so the outcomes are probably not as good.
Yeah.
Using AI as an example, when you've identified these large, shifts and you're trying to find the winners that emerge out of it, how quickly are you actually moving throughout the research process in terms of deploying capital, and are you waiting until you have a fully formed thesis on that winner, or what's the process over that period of time?
Yeah, it's a great question. So things are now moving fast, right, in AI, right? So, there's a great line. There's 3 ways you make money in this business. One is to be smarter than the other guy. The other is to cheat. And the other is to just be first, right? And so we don't cheat. We think we're pretty smart, but there's a lot of benefit in being first, right? So sometimes you just got to be first. In this case, things are moving really, really quickly. So we are on the phones regularly. I just got back from the United States. We spent 3 weeks there seeing all the major companies down the valley, and everything they told us was more inputs into our models, right? So all of that stuff becomes inputs into the financial models we built. And then the financial models basically tell you, is there upside here versus the share price? That's how we think about it. And so luckily we've got a good team that builds the models. And then luckily we've got good access that gives us the inputs. And then if we find that information out before everyone else has worked it out, then, that's important. So we've spoken for a long time, and I'm sure Kieran did, about, the fact that the hyperscale data centers would do nuclear deals, okay? We knew this because we run a climate fund which invested in nuclear energy companies. So the nuclear energy companies were selling us exactly the same thing that Microsoft and Facebook were telling us. So we knew this was going to happen, and so we worked that out first. We put those deals in our model, worked out there was significant share price upside. Obviously some of these have since been announced. We didn't know they were going to be announced, but we knew that they were both talking about it, and that's equaled upside in our investments. And that's as other people work out the mathematical upside that we've already worked out.
So we're not going to ask you for any particular companies or like any stock tips or anything like
Online.
that. But I guess from that trip in the States, were there any like really interesting insights that you want to come back and make us known about here in Australia?
Yeah, I think the biggest insight we got was that there's this conversation about ROI at the moment, what's the return on investment and all these big models. The interesting thing we got is, if you look at GPT, the first ChatGPT, it was built on like 10,000 Nvidia GPUs. GPT 4.0, which we've got right now, is built on about 25,000 Nvidia GPUs. And, the Strawberry version, potentially more than that. And anyone listening who's a ChatGPT subscriber knows that there's quite a significant difference between the two. So what they all told us was that there's no diminishing returns at scale. If we spend more on compute, these models will just get better and better and better. And so then Elon's worked this out. So Tesla's gone and built a 100,000 GPU cluster, which they just started up the other day. Be interesting to see what comes out of that. Facebook's trying to build a 200,000 GPU cluster. And Nvidia and Broadcom both told us that their clients have asked for equipment that will enable to stand up a million GPU cluster.
Wow.
And so a million GPU cluster will cost roughly $30 to $50 billion. It'll need a gigawatt of power, hence these nuclear deals that are being announced. So the ambitions of these companies are ginormous. And there's been at least 3 or 4 of these things potentially built. So God knows what's going to come out of them, quite frankly. But what was really interesting is that we went there sort of with a view that, geez, a lot of this has already happened. Like Nvidia's already nearly the biggest company in the world. A lot of it had already happened. But what you come back discovering is you're probably only 2 years into something. that's probably going to last 5 to 10 years. It won't be a straight line, but the investments that they're going to make here are going to be very large. The outcomes are probably going to change the way we think about the world, which makes it a really exciting time to be looking at this. So that's why we're looking at AI at the moment, because it's changing really quickly.
Wow.
And it's just that the big tech guys are going to keep getting bigger.
The big tech guys are going to spend a lot of money.
Yeah.
Whether they get anything out of it or not, I suspect they will. But Nvidia's the winner.
Yeah.
Nvidia's still the winner in our view.
Yeah.
In our view, not stock advice. in our view, Nvidia's still the winner here.
Yeah.
It's a really exciting time. Like I said, coming back to the point, it's an exciting time to learn and try and be first. So yes, it helps to be smart, but it definitely helps to be early.
Well, Nick, throughout this conversation, we want to try and draw out some more insights, both that you're sort of learning about now, but also that you've learned through the journey. But in this series, we really want to, unpack, your investing philosophy, and we really want to speak to some experts that have really captured our imagination on what we can do as investors over the journey and kind of understand your journey and how you learn and then, what you're doing today. So let's go back to the very early days, like Nick Griffin, when he's coming out of school, thinking about, the world and what he wanted to do in it. What were your goals at that time, and particularly relevant for this conversation, how were you thinking about money and investing at that time?
Yeah, okay. So look, obviously everyone starts the same way, and I'm pretty sure most people on this podcast will relate to this. You buy, 10, 20 cent mining stocks that you think are going to turn into $20 billion companies. And the vast majority of them don't. That's how we all start. And you get a bug out of that effectively, like it's enjoyable. Because you're not gambling per se. It can feel like you're gambling, but you're not actually gambling. You're just trying to prove your edge on discovering what's going on versus your peers. And that's the same today. You just get smarter at it, if that makes sense. So that's how you start. That's how I got into it. Back then, there was a lot of privatizations happening in Australia. So Combank got privatized, Telstra got privatized. These were pretty easy wins for a 15-year-old. So you got some pretty good wins on the board early. Yeah, and that's how the bug came from. That's how everyone starts. That's how I started.
Yeah. What made you at 15 want to invest though? Like it's a...
Yeah, look, my dad was in the industry. So yeah, he sort of passed it down at the dinner table, and I seem to be doing the same thing to my children. And that got me into it. But like I said, it was very interesting at the time. Economics is your favourite subject.
Yeah.
I went on to do a commerce degree.
Yeah.
I was probably always going to invest.
Were there any specific things that happened to you from an investment point of view at that time that were lessons you still hold on to today?
No, back then was just fun.
Yeah.
It's still good fun, by the way.
Yes.
It's still good fun. Back then, yeah, you lost some money. You had some good wins. I mean, it was more getting the bug. I don't think there were any particular lessons at that time.
Yeah.
After I left uni, I got a job up here in Sydney working for Commonwealth Financial Services at the time. Was a good fund manager. They ran the Officers Superannuation Fund, which is the super fund of the Commonwealth Bank. And then it gets even more fun because then you sort of start meeting all these legends of the industry. Like you get to hang around with. It's really cool. You're like in your 20s and you're drinking from the fire hose because you're surrounded by people who've done it for a long time who are very smart. And you get to meet, the CEOs of companies just because of the capital you have behind you. So you have no idea what you're doing. You're just like a deer in the headlights. But you're just immersed in it, and then it becomes even more fun again.
Yeah. So over the journey, you've worked at a couple of different fund managers. What were some of like the big lessons that you took from that time that sort of informed what you're doing today at Munro?
Yeah. Okay. So there's a couple of things that over time that we worked out, or over time I worked out. So the first one was, after a while, the Australian equity market just sort of became too small, quite frankly. It was interesting, but it just wasn't that interesting. And, most of these 20-cent stocks, weren't working out. And the best idea was offshore. We could identify the big area of structural growth, but guess what? It wasn't listed in Australia. So first thing you worked out was had to go global. And I went and travelled and lived overseas and worked at on the sell side as an oil and gas analyst, if you believe it. I worked at other fund managers along the journey. So I spent a lot of time overseas. And so my eyes got opened up by that in a big way. And so the first thing you worked out is you had to be global. If you're going to do this properly, you should just do it globally. The second thing we worked out was, that if you're going to take a global view, then it's a bit pointless trying to work out what retail sales in France are going to be. It's just not that helpful. or what retail sales in Australia are going to be. You know, so the macro just becomes much less relevant. I've got a much bigger sandbox to play in. I'm only trying to invest in a few things. Then, you know, let's just focus on structural change. So the second thing we worked out is, you know, first thing was go global. Second thing was just focus on structural change, because that's where the big winners come from. You know, card to cash, Visa and MasterCard. It's not hard. Why are you stuffing around with like Best Buy or, you know, like, you know, some retailer? It's just not worth the effort. Why are you trying to buy a bank? You know, there are good banks. We talked about one or two of them, but, you know, they're all leveraged to the economy. Try and find the big structural trends. So the second thing we worked out was just focus on the big structural trends. And then the third thing that we definitely worked out was there's only a few of these. So just be concentrated and try and get all of the work you've done, just convert to these big winners. These big winners are about, every investor will tell you this, you know, just find your big winners and run them and do it concentrated. So you've only got so much time. You've got the whole world. Focus on the structural trends, find the big winners. And so basically the entire process was built out of those three covenants. And that's the process we've been running now for, you know, nearly 20 years, and it works very well for us.
What's concentrated for you? How many positions?
Look, concentrated, what's interesting about this is like concentrated for us in our funds is like less than 40, but we do have some funds where we run less than 20 and they consistently outperform the ones that are less than 40. So less is always better. You know, it's always about like, what's your best idea? And don't let your best idea be diluted. Now, people like diversification and things like that. And so you know, people get upset with volatility, particularly in my business. So you can't be too concentrated, but concentrate. Those are the sorts of numbers we're thinking about.
Nice.
In the whole world, that is.
So I remember when we interviewed you back in COVID days. Yeah. And right at the end of the podcast, you said, I have what was it?
It was the best
company in the world that no one's ever heard of.
Yeah. And now everyone's heard of it.
And it was ASML.
And we had never heard of it.
And we'd never heard of it. Yeah. And it just stuck with me and because everything that you just said there came out in that interview, global and being super concentrated and best company I've ever heard of. Now, obviously it's had a bit of a challenge recently, but what's the ASML of today, or what's the... Well, yeah, what are you looking at?
This isn't a buy, hold, or sell. It's just like you always seem to have like these unknown companies that are like right on the cutting edge. So not to put you on the spot, but
you have put me on the spot. What's the ASML of today? Like there's lots of ASML is very unique because it's effectively a monopoly, and has been a monopoly for 2 decades or for a decade, and we'd owned it for a decade, and it's a monopoly on shrink, which means it accelerates computers globally. It helps computers go faster. That has been the case for a long period of time. We are getting close to the end of shrink. You'll get to the point where, and we're already seeing this, where companies are struggling to get shrink to go Moore's Law to continue. Moore's Law is struggling to continue, and eventually, you know, that potentially means that ASML may eventually turn into just a normal company.
And by shrink, you mean making semiconductors and chips
okay. So sorry, Moore's Law is how many transistors you fit on a semiconductor. The more you fit on, computers go faster and cheaper. So that basically drives everything. So we used to have a PC, then we could put a computer on a phone. First internet on your phone didn't work well at the start. Now it can stream a movie. Packet sizes get smaller. All of this happens because of transistor density on semiconductors, which ASML is effectively the responsible for.
Now, it is you're saying that we're almost at the end of shrink as if it's just a statement, but it is like a big statement that you're saying, because we are seeing a lot of the big technology companies try and go smaller and smaller. We're seeing moves to go from a phone to a headset. We're seeing Elon try and go to a chip in the brain. Like there's a lot of capital tied up in the idea that we can still make computers smaller than they are today.
Yeah, it's not that they're smaller. It's just that it's not that you shouldn't think about it as physical form.
Okay.
You should think about the fact that the more transistors you get on a semiconductor, the more it can do. So the more compute power it has. Does that make sense?
Okay.
And so the compute power it has will either make something that was there before cheaper, or usually make it cheaper and better, which means, you know, you have laptops now, whereas 20 years ago, IBM would sell a mainframe for like $10 million that did less. Does that make sense?
Yeah.
So that makes technology more ubiquitous for you, which means it grows. From here, you know, if we run out of shrink, and we're off on a massive tangent here, and it's your own fault for asking.
That's good.
We love this. This is great.
Okay, so the company that controls all accelerate compute power from here is actually Nvidia. And I know it's not a new and hidden idea, but Nvidia is the guys who now can accelerate computing beyond Moore's law. And so they now become the gatekeeper of all future compute power from here, which is why the company has been so successful, because they found a way to bend Moore's law. And they've bent it to their will through accelerated computing, which is why everyone's adopting it. What's the next one? Like the hidden one? Yeah, I'm going to have to hang on to that, I'm afraid.
Yeah, fair enough.
I'm going to have to hang on to it. But that's the question on ASML, and that's why you're seeing this sort of handoff from one to the other at the moment.
Yeah, okay.
So just sticking on ASML then, you said you've held it for a decade, or had held it, and at the time of recording it got smashed sort of 20% or thereabouts. But how do you think about that? Any sort of
Yeah, okay, so let's bring this all back to what we were talking about before, okay? So remember, okay, you got to go global, you got to go structural, and then you've got to be reasonably concentrated, okay? So in ASML's case, you could have owned other semiconductor equipment companies, but ASML was the one in the best position, and so it performed the best over, say, the last 20 years. We've owned it for more than a decade. We probably made 20 times our money on it in that time horizon.
You just if people are listening along, just get the chart up. It's
No.
pretty incredible.
But anyway, like all good things in life, sometimes they come to an end. Maybe this one has come to an end. Maybe we've run out of shrink in Moore's law. I don't know the answer to that. But the point is the last thing I just say is that, okay, if you took on everything I just said, you're going to make mistakes. Like you have to. There's only a few great companies in the world. 96% of all companies that list don't create any value at all. 4% of companies that list create the entire value of the US equity market over the last 90 years. That's 1,000 companies out of 26,000 listed. And the top 50 of that 1,000 make up nearly half the returns. Yeah. So it's 50 companies out of 26,000 companies over the last 90 years. Okay, so why does the index keep going up, yet 96% of companies don't make any money? It's because the index is working on this few winners concept, right? It's the S&P 500, it's the ASX 200. So the best companies always end up in the top 500. And so this is why everyone gets confused. The equity market's not the economy. The equity market's a collection of amazing companies doing amazing things. Not all of them, but a big chunk of the bad ones get kicked out. So coming back to the point, you are going to make mistakes. And so the last bit of the process that really sort of unlocked a lot from us was just having a formalized stop loss process or a formalized trigger process. So if a company falls 20% or a certain number from a certain price, we're forced to review it.
Right.
Okay.
Everyone listening to this podcast has a stock they've lost 90% of their money on. I can pretty much guarantee it. It's sitting in the bottom drawer. It was a good idea at the time. It just didn't work out. That's fine. That happens to everybody. Most good fund managers have a batting average of roughly 50%.
Yeah.
Roger Federer, what's the stat? He won 80% of his tennis matches. He only won 54% of his points. You're going to make mistakes. What you have to do is find a way of processing that mistake and removing it from your list and then focusing on the good ones. And so that stop loss process or that trigger process is a reaction function. It allows you to assess whether the facts have changed. Finally answering your question, ASML's obviously had a bad week. It would be under our process triggering. So we are not now reviewing, have the facts actually changed here? And if they have, then we should go do something about it.
Yeah.
Because 20 times in your money is certainly not a mistake.
Yeah, I know.
Yeah, but the last thing you
Damn
want.
it wasn't 20
No, you're right.
times.
It's been great. It's been great, and maybe this is how it ends.
Yeah.
Maybe it's not. But you've got to have an open mind about that.
Yeah.
Otherwise, you'll keep doubling down the whole way down, and you'll give back all the money you just made on this great idea.
Yeah.
And you have to work on the assumption that, very few of them are going to turn out like Nvidia or turn out like Amazon. Most of them are probably going to be mistakes. So you've got to have an open mind about that. And even the ones that turn out like ASML has, at some point, we made a lot of money out of PayPal. We owned it for years. It did not work out. We made a lot of money out of Tencent. We owned it for years. It did not work out.
I feel like you're being a bit hard on yourself.
No, I'm not saying it didn't work out. I'm just saying that we sold them very well. But we sold them very well because we had a reaction function.
Yeah.
Yes.
Yeah.
And so for anyone listening, just do the maths on the whole thing. Like there's only a few winners. Roughly 50% of your ideas are going to be mistakes. So your process for managing mistakes should be just as good as your process for finding your winners.
So you mentioned there one part of that process, which is that automatic review if it falls a certain level. Are there any other like risk management processes or rules that you have at Munro that maybe we can think about implementing personally? You know, like position sizing or anything like that?
Yeah, position sizing is a really good one. Diversification is the big free bet for any investor anyway. Diversification to an extent, but is very helpful because you don't want any one idea hurting you. So generally for us, that number's 10% would be a maximum. And I think that's a good rule to use. The only other one was, like generally if you've got a good idea, we would use in, these good structural areas of growth, they can't all be in the same structural area of growth. So, so we've been invested in the GLP-1 drugs for a long time. They're not correlated to our AI ideas, if that makes sense. So, if something goes wrong with GLP-1s, that will hurt, but it shouldn't hurt the AI investments. Does that make sense? And, we've been investing in decarbonisation for a long time. If something goes wrong with, the IRA, for instance, in the US or something, that shouldn't hurt the GLP-1 investments or the AI investments. So don't invest in just one, don't have all your ideas just in the same structural area of change. Those would be the simple tricks that are out there.
Love it.
So Nick, if you had $1 million to invest today outside of your own funds, how would you be doing it? Or maybe like from a principles-based point of view, or just sort of help us think through how you as an expert investor would be deploying $1 million?
They'd go in my own funds.
Of course, that's the first answer.
Well, look, personally, I don't invest privately anymore. I just invest in my own funds. I've sort of banned that for, people who work at the firm.
Yeah.
Or at least the partners at the firm. But look, I think for a private investor, I'm going to blaspheme here, but for a private investor, don't underestimate the power of the index. The index is very powerful. Its ability to choose the few winners for you over time. So a certain amount of money, in theory, should be indexed. And then a certain amount should be invested in, not too many companies, but companies that the best trick you can do for yourself is if, say you weren't allowed to sell. Like the problem with the equity market is you can sell whenever you want. You can buy whenever you want. So you just get sucked into trading the whole time. And you'll end up selling Amazon because you're worried about something Donald Trump said. And it's like stupid because they're two independent things, right? Like Amazon's taking share in e-commerce and cloud computing, and Donald Trump's just saying stuff. So don't let the two things cloud themselves. So when you're investing, try and think about if you bought it and you weren't allowed to trade it for 10 years, would you still want to buy it? Those are the best companies to invest in.
Yeah, love that. So Nick, we want to close with a few questions that really try and draw out some lessons for the audience. I feel like we're double dipping because I think this whole conversation's been filled with really actionable and insightful lessons, but I'm going to try and double dip anyway. So earlier we were asking about, you as a younger investor when you were just getting started. If you could go back, tap that Nick on the shoulder and impart one lesson, what would it be?
Yeah, block out the noise. It's really simple. Still happens today. Okay, you have to understand that there are whole newspapers and television channels that are dedicated to get your attention about what's happening in financial markets, okay? And so they spend their entire time trying to explain what's happening based on, it's risk on, or, people are worried about rates or growth slowing. And they'll always go back to the economy. They'll always go back to the economy because that's the one thing that they can constantly fill news with. Does that make sense? So they'll try and convince you that the equity market and the economy are the same things, okay? They're not. The equity market is not the economy. The equity market is not the economy. I'll say it over and over again, okay? The stocks that you're investing in are generally being driven by a large structural change or their competitive position. That's what really matters over a 5 to 10 year view. And all that other stuff is noise. And the whole industry is designed to push it down your throat. And the quicker you block it out, the better you will become as an investor.
Except for podcasts. Podcasts, not like the rest.
100%. Podcasts, not 100%. But to you guys' credit, I'm pretty sure you're not doing podcasts on the macro all day.
No.
So that's not noise, that's learnings. That's learnings. And look, I listen to podcasts too. Particularly if I want to learn about a subject. But if you're just listening to a podcast if you're stuck listening to what central banks are apparently going to do, that's not a good use of your time.
And then Nick, to close, is there any conventional wisdom from within industry that you think is wrong or doesn't really align with your style that you constantly hear just repeated over and over.
Oh, damn it. I just answered that question.
Yeah, true. Any other?
Try another one if you want. But yeah, the stock market's not the economy.
Yeah.
Mm.
Yeah.
It's not. Everyone tries to connect them.
Yeah.
It's not. And like the S&P 500 is the furthest away from the economy. The Australia is a bit closer because, you know, we've got banks and resources, etc. But if you take the global market is not being driven by global economics. Okay, think about it this way. The average return on the S&P 500 over a long period of time is 8%. The average GDP in the United States over a long period of time is 3%. So what's the difference? And then compound out the difference.
Yeah.
The difference is that these companies are growing above GDP because of these big structural changes that they're leveraged to, Nvidia, Amazon, Tesla, Apple, and all the next ones to come. You're effectively not buying the economy, you're buying a warrant on human innovation.
Nice.
Your job is to find the warrant over the innovation that you want to invest in. And that's where you got to go do your homework.
Nice.
And be first, and all the other things we talked about today.
Nice. Well, Nick, great way to end. We really appreciate you taking the time, and it's always such a pleasure talking to you. As Ren said throughout that, we always leave with so many lessons and ideas to think about. So thank you so much.
Thanks, Bryce. Thanks, Ren. Thanks for having us.
Now, before we go, we want to say a huge thanks to Viola Private Wealth, who turn complexity into clarity. With a highly personalized approach and a proven track record, they simplify wealth management so that you can focus on what matters most to you. For more information, head to violaprivatewealth.com.au.
So make sure you stick around for this summer series. We've got 11 epic episodes to go. Next up, we've got Peter Neville, the former Australian Test cricketer, who actually is now a financial advisor at Viola Private Wealth. So make sure you tune in there. And then stick around over summer. We've got Ben Griffiths, notable small cap manager. We've got Jeff Wilson, the absolute icon of the industry, and a whole lot more to keep you listening and learning over summer.